Morning, ladies and gentlemen. We want to continue with our class, and today we are going to talk about the various types of bill of lading. We want to see that how many types of BL do we have, which are being used in the international trade, because you know that in international trade it involves a lot of paperwork, and for me to know that this cargo belongs to you, then you must produce the papers. And one of the key papers which is normally used as an evidence of goods received for carriage, as an evidence of the title to the goods, is always the bill of lading. So a bill, it comes in various forms, and we can have what call on board and received for shipment. When we talk about the on-board bill, this refers to the merchandise that has been physically loaded onto a shipping vessel, such as a freighter or a cargo plane. So once you have handed over your consignment to the carrier, the type of bill which you are given, we consider that as what's called the onboard bill of lading. Another type is received for shipment BL. Now, this one comes when the merchandise has been received, but it is not guaranteed that it is not guaranteed to have already been loaded onto a shipping vessel. So typically, it will be issued by a freight forwarder at a port or a depot, and such BLs can be converted upon being loaded. So it's just simply acting like a receipt that I've received your goods and they will be loaded. And sometimes we call it the mate receipt. In some cases, it is normally called the mate receipt, that we acknowledge that yes, you have received your cargoes, but yet they are not yet loaded on board. Now, we also have another type known as the straight bill of lading. Is used when payment has been made in advance of shipment and requires a carrier to deliver the merchandise to appropriate party. So this normally occurs when the intended seller, that is, has already made payment in advance for the freight services, that is what you call in some other terms as a freight prepaid. And in that case, you're issued what you call a straight BL. So which means at the port of discharge, there's no further demand as per the payment of the freight or the transport fee for ferrying your cargoes. Then we have an order bill of lading. This is issued when shipping merchandise prior to payment, requiring the carrier to deliver the merchandise to the importer, and at the endorsement of the exporter, the carrier may transfer title to the importer. So endorsed. So this one, the order BL, as you've said there, that is given prior to payment. So you haven't paid the cargo, but the carrier has accepted to carry them on board. So which means that we are going to have a type of freight called freight collect, which means at the time the importer at the other end going to collect those cargo, then that is the time when he or she will pay for the freight charges. And it normally comes with an Incoterm like the free on board, that is FOB, okay? Which means that the seller's obligations end when he has loaded the cargo on board the ship, and from there his risk and liability ends there. And it is upon now whoever is importing this cargo to ensure that the freight are paid. Now, endorsed order bill can be treated as a security or serve as a collateral against debt obligation. So in case you fail to pay, then the master has got all the right to hold that cargo and even go back with it. So it acts as a collateral. Now, BL and charter parties, when compared, we know that a bill of lading is it is a document that acts as a receipt of your cargo on board the vessel. And we have another document which is normally called the charter parties. Now, charter parties in a layman language is a type of document that is given to whoever hires a vessel or whoever charters a vessel. We don't hire vessels anyway. We charter vessels. We charter aircraft. We charter vessels. So when you charter a vessel, either substantially, that is part of it, or the entire vessel, you will be given a document known as a charter party by the the vessel owner. But when I simply maybe I have containers, let's say I have 100 containers I want to ship, my 100 containers may take just a small space within the on board the ship. So I book the space. So for the space which I booked on board that particular ship, for my cargo to be shipped together with other people's cargoes, then with that I'll be given a document known as the bill of lading. Okay, yeah. So the bill of lading is um, evidences a contract between the shipper, that is the exporter, and the carrier, while the charter party evidences a contract or that a ship has been chartered or a ship has been hired for a given period of time. And we have various types of charters. We have what we call a voyage charter, we have time charter, and we have demise charter. A voyage charter is a short time lease of the vessel. It can take a period, maybe months or a year or two, if it takes a longer period. Then we have a time charter, can go even up to around 5 years, or when the ship is in under your care. Then the mother of all is called the demise charter. The demise charter, you can have the ship in your possession even for its entire lifetime, maybe for 15 years when you're just using the ship. And the only thing which happens here is that you pay the ship owner according to the agreement which you had with him. Okay, so the same with the time. And also you find that under these particular charters, there is the obligation of the charterer and obligation of the ship owner. What the person who hires the vessels, the charterer that is supposed to do, and what the person who has given out the vessel, that is the ship owner, is supposed to do. So those ones we learn in another chapter. Now, we also want to differentiate between the Seaway bills and electronic data interchange. Now, under the Article 3 of the Hague VCBI rules, a carrier must, on demand, provide the shipper with a bill of lading. But if the shipper agrees, a lesser document such as a Seaway bill, a lesser document agrees, a lesser document such as a Seaway bill may be issued instead. So we can have two documents which can be issued in this case, either BL or a Seaway bill. But what is the difference between these two documents? Now, it is said that the use of bill of lading has been declining over the past periods, and they have tended to be replaced with another type of document which is known as the Seaway bill. Now, the BL is normally declared as a non-negotiable. It's normally a negotiable. That it is said that if the so-called bill of lading is declared to be non-negotiable, if it is non-negotiable, which means that it must be to the person that is named there, it is non-negotiable, then in that case, that is not a true BL. It will be treated as a Seaway bill. So which means, in short, a Seaway bill is a non-negotiable document, while a BL is a negotiable document, okay? Yeah, so the main difference between the two is that the Seaway bill, or the way bill, gives the bearer the right to possession of the cargo, but does not confer title the goods. So in other terms, is that a Seaway bill is not a document of title, but gives you the right of possession. So as a result, there is no need for the physical document to be presented for the goods to be released. So when you are, unlike the cases whereby you're using the bill of lading, where you have to present the physical document, with a way bill, you don't need to present the physical document. So long as that you can justify that you're the rightful owner, then the goods will be released to you. So the carrier will automatically release the goods to the consignee once the the import formalities have been completed. And this results in a much smoother flow of trade, and has allowed shipping lines to move towards interchange, um, which may greatly ease the flow of the global trade. Now, over some period, it has been the case that cargo may arrive at the destination before the BL. And the practice has arisen for the shipper to send the consignee a letter of indemnity, which can be presented to the carrier in exchange for the cargo. So there have been cases whereby the shipment has arrived before the document that justifies that particular shipment belongs to you, which should not be the case. It should be that the document will arrive prior to the shipment, but some cases do arise whereby the shipment arrives before it arrives before the shipment. So the shipment arrives before the document. Yeah. So as we were saying that in a case whereby the document arrives late, and you want to collect your consignment, then the only thing which is available here is that the shipper must send you a letter of indemnity. And why do we need this? This indemnifies the carrier against any cargo claim, because maybe you are not the right person, and I've released the cargo to you, and then the other person, the rightful owner, comes with the original BL. So what will I do? And I've already done that. So in this case now, he needs a letter of indemnity, which now protects him from further claims that may arise, even if the rightful owner now presents the original bill of lading. So for the letter of credit and collection transactions, it is important to retain the title to the goods until the transaction is complete. So this means that the BL still remains a vital document within the international trade. So it's a very, very important document. So in other ways, to overcome the possibility of the goods reaching the destination ahead of the document, I mean, it's not the cargo, please, pardon me there, ahead of the document, majority of the shipping lines offer what called express release service, what in the past was known as the telex release. By surrendering the full set of bills of lading issues at the port of loading, the shipping line can instruct the port of discharge to release the cargo without the physical presentation of the BL at the destination. So the world is becoming digitalized, and we even came to realize the importance of digitalization this year. The world came to know that technology is very important because of the pandemic which came. The pandemic hit the world very strongly, whereby we are told don't touch, don't be in close social contact. So these things were sending people back home. You work from home. You use electronic means. There is no paper exchange. So this has had a very, very negative influence in the economy of the world. And the world has realized that things can move even without people presenting themselves physically into the offices. So even this one, the electronic systems of clearance of cargo have also been adopted by various port states around the globe. So electronic bill of lading, it is not something of yesterday, but it started some times back. It has sought a solution to the difficulties that the cost and the efficiencies associated with the paper BL. And as I mentioned somewhere that you find the paper bills, sometimes there's that aspect of delay. So it arrives late. And when this happens, we know the consequences that I may not clear my cargo in time. The cargo is going to remain in the port for a while. And when this happens again, another associated cost comes, what we call the demurrages and the cost of storage. So to avoid those ones, then we must speedize means by which this can be done in the quickest time possible. So one answer to that is the bill to be an electronic document. And an electronic bill is the legal and the legal and functional equivalent to a paper bill. So they're just the same. All this one now is is presented in soft copy as opposed to the paper one. So an electronic bill of lading must replicate the core functions of the paper bill of lading. So it must serve the same functions which are being performed by the other one. And it functions as the three key functions, that is the receipt of cargo, the evidence of contract, and also the document of title. It must still serve the same. Then UK Carriage of Goods Act of 1992, Section 15, enables traders, a trade minister to make regulations for electronic transactions. So you see where the electronic transaction started. It started several years back. That is in UK. So as I'm saying that the UK government through their Carriage of Goods came up with the Carriage of Goods Act of 1992. Section 15 enables the trade minister to make regulations for electronic transactions. But as we speak, no such regulations have been made, and electronic interchange is already lawful. So UK is like they saw this thing several years ago, 1992. That is far when even technology was not all well that advanced. So electronic clubs such as the Bolero have been quite successful, but the maritime trade community is traditional and loath to move away from the paper transaction. So progress has been very slow. So maritime community is too traditional, but the situation has proven that technology is needed, and they are rolling themselves towards that, though not at the pace which is required. So in the recent time, it has been proposed that the blockchain technology may be the answer to cover the myriad steps in the export trade transaction, and thereby enabling electronic transactions and information transfer that is both speedy and reliable. So the word loading, which is used in the BL, simply means to load. Okay, so it simply means the aspect of loading the cargo on board a ship. There's a Dutch word which has exactly the meaning of that, the freight cargo or amount of transportable goods. But under the English law, the Carriage of Goods Act of Goods by Sea Act, that is 1992, provides that the term bill of lading includes received for shipment, BL issued by, say, a freight forwarder or a storage depot or warehouse. Then a combined BL may be issued by a carrier who, say, collects goods from factory for subsequent delivery to a ship via a multimodal transport. Now, we want to see the roles which the financial institutions like banks play in the global trade. So banks are very important facilitators when it comes to the global trade. Apart from the provision of the liquidity, that is the cash required, they also guarantee payment for around a fifth of world trade. So banking sector plays a very vital role in the international business. So as we speak, almost all banks have formed collaborative alliances, and they have established a correspondent banking relationship with the banks in other countries to better serve the international business community. So they play a clear role in forming a bond of trust between buying and selling agents, executing transactions in the international market. So the local banks have their branches outside the country, and these assist them in effecting international payment, thus making the receipt and payment of goods and services by its local people. So they play a pivotal role in foreign trade through the provision of financial structure and the instruments necessary for the conduct of business transaction between the foreign buyers and the sellers. So they ensure safety and transparency in the flow of the documents and money, and the buyers of goods from abroad and their sellers always want to be assured of the payment, because you are dealing with somebody you don't know. He's sitting on the other side, you're sitting on this other side. So there must be that kind of trust, and this trust is only assured by the bank. So, and the buyer one would want assurance that all terms and conditions of the purchase agreement are kept. So this requires that the banks come into broker an agreement and work as the intermediary between the importer and the exporter. So they play a key role by providing assistance in many ways to facilitate international trade, business, which encompasses financing, working capital requirements, financing to capital goods, identifications of potential markets of international trade. They also help in identification of buyers and sellers, facilitating payments for the international trade transaction. They issue import letters of credit. They also conduct the pre and post shipment financing and guaranteeing payment under the letters of credit issued by the other banks. So the most common instrument used for payment and shipment control is the LOC, that is the letter of credit, which is issued by the bank of the buyer in the favor of the seller. So after the bank of the buyer approves the issuance of the LOC, the issued LOC is sent to the advising bank that establishes the authenticity of the instrument, and thereby informing the beneficiary of that particular receipt. Now, the advising bank may confirm the letter of credit after checking the TOC, that is the terms and conditions, for payment by adding its own guarantee to that of the issuer. And commercial banks facilitate trade and payments of funds through documents. After all the terms and the conditions of the shipment and the quality standards have been checked via the presentation of proper documentation, the issuing bank pays the seller for those goods. So you see how the bank, the way they are playing a very key role here. Banks can have assurance. They can have assurance with the other bank, but you dealing with the client directly, wiring the money, my friend, you may cry for investing in air. So the post-shipment facility provides a short-term financing to exporting manufacturers, distributors, service providers, and the businesses receive financing in the form of loan equivalent to the invoice value of the export sales. So this must be repaid from the assigned proceeds of payment. So the post-shipment facilities, its key aim is to bridge the gap between the settlement of production costs and export sales receipts. So they allow the business to accelerate the cash flow and shorten the operating cycles. The advantage which comes with this is that financing mechanisms are that the exporter's working capital cycle is shortened, and this allows for increased production levels, and the exporters are able to convert a credit sale into a cash sale. And by doing this, is freeing up their capital for further exports. While on the other hand, the pre-shipment financing is a short-term loan or a direct financing that a commercial bank extends to an approved company to assist in the payment of the inventory. So, which may involve these inventories here may involve things like the raw materials, semi-finished or the finished products, just to mention a few. Now, once goods are received, the exporter can now prepare products for local sale or export. And the pre-shipment facility is offered at a very competitive rate, and it is meant for trade transactions that are short-term and self-liquidated. Now, the merits that comes with these types of financing is that the company is over the credit terms so that it can add flexibility to its cash flow. And by doing so, they manage the business more efficiently. Now, also provides extra time for goods to clear customs and to be resold before you need to pay for the goods, and also suppliers are assured payment upon request from the exporters. Yes, so I think you have learned something on the various types of BL, the roles that banks are playing in the international trade. And now, I want us to I want us to see insurance documents. We know that insurance is playing a very, very key role in securing our shipment globally. And you find that it is advisable that you secure your shipment, because normally we have got a lot of uncertainty in the international trade or in the national shipment. Anything can happen to your cargo. The ship can circumcise. We have got heavy storms. It can be stolen. So anything can happen. So it is advisable that you secure your shipment so that it arrives safely, or if in case there is a loss, then you're assured that you will be compensated. In many occasions, we find that most importers relies heavily in foreign insurance companies, and many shippers, they insure their cargo internationally. It is not bad, but the challenge comes when you want to be compensated. Why you want to ring an insurance firm based in China or based in Japan, and you are based here in Kenya, for example. And when they realize there's a problem, they may challenge even with the language. They may assume that they are not getting whatever you're trying to say. They start speaking their native language just to uh, brush away. So we are now championing that all cargoes be secured locally with the local insurance. For one, it is going to earn us more revenue. The revenue authorities, even the government, you're not going to lose your money to the foreign insurers. So most traders are now being encouraged, insure your cargo with the local insurance firms. And by doing so, you are assured in case of any uncertainty, you know whom to approach. And also, the money is also circulating within the country. So we have various instruments or various clauses within the insurance. And the first one, which want to see the certificate, the insurance, the cargo insurance certificate. Now, this is one of the key document in shipping, since they carry the most risk. So a cargo insurance certificate is a document that indicates that the type and the amount of insurance coverage in force for a given time, given item, I mean. So it is used to assure the consignee that the insurance is provided to cover loss or damage to cargo during the shipment process. What does it contain? It contains the conditions of the coverage. It has the shipping information, additional or any special condition of coverage, instructions or actions to be taken in the event of loss or damage, settlement agent contract information, liability of carriers, the bailees or other parties. Then we have marine specific document. We have open covers and we have marine covers. An open cover is simply an agreement binding in honor whereby the insured will undertake to insure all shipment declared by the insured, and the assured to declare each and every shipment which comes with the scope of the open cover. So with this type of cover is binding the insured to undertake to insure all the shipment which he has declared, and the assured must also be ready to cover such kind of cargoes. So premium is normally payable on each declaration against which specific stamped certificate policy is issued. Like I have household equipment I want to ship. Maybe in open cover, I want to be, I declare each value of each item as they're being covered. What advantage which comes with the open cover? Once the arrangement, once arranged, I mean, the insured is guaranteed protection on the agreed basis for the shipment, subject to declaration of full shipping details. The client is relieved of the necessity to negotiate the insurance of every shipment individually. The premium rates are agreed at inception, and this assists the insured to identify his cost of insurance right at the outset. However, for legal purpose, open cover is treated as a cover note, but not a policy. Therefore, it is not stamped. The basis of valuation The basis of valuation